Well, hello again, everybody. This is John Norris at Trading Perspectives. As always, we have our good friend Sam Clement. Sam, say hello.
Hey, John, how are you doing?
Sam, I'm doing fantastically today, and you know who else is doing great?
Who's that?
Everyone that predicted that the Federal Reserve would cut the overnight lending target rate by 50 basis points.
Pretty much anybody involved with the market nowadays.
Well, I still wasn't quite so sure. It's not that I didn't think that they needed to or should have. I just, I was thinking these guys are a bunch of academics, a bunch of bureaucrats. They've always been sort of very gradualist. The economic data is not so dire, or at least officially, that, hey, we got to do something outside of the ordinary. So while I thought 50 basis points was the appropriate move, there was enough of a sort of a question mark in my head. Would these bureaucrats do what they should do, or just the old tried and true, and let's be as gradual as possible?
There was a lot going on, and the timing of it also added some question marks because people talk about the apolitical nature of the Federal Reserve, or whether that's true or not. But elections coming up, the perception, at least, that you're supporting the party that's the incumbent if you're starting to cut before. So the timing just made it more kind of questionable. But I think you and I were both on the same page. This was the right call. You take politics out of it. You take economic data and put it in the focal point, and it was the right call. Inflation's slowing down significantly.
The labor market looks like it's cooling off.
Things are cooling off a little bit.
But nothing's completely falling apart. It's not that doomsday scenario. It's not, oh my God, the devil's coming to dinner or anything like that. Just sort of standard economic slowdown, what you might expect towards the tail end of an economic cycle. And here I think the Fed is doing what it thinks it needs to do in order to have that proverbial soft landing.
That's right. And, we talked about this earlier, and I had a speech where I mentioned this morning, and that, the fear is that the porridge doesn't go from too hot to too cold immediately, right? So even if things are getting worse, there's going to be a time in between where things are pretty good, right? And so that's the fear. Things are good right now. But, we've moved from 3.9% to 4.2% unemployment. That's still very strong.
Yeah, listen, when I started in the investment industry back in the early 90s, 4.2% unemployment rate would have pretty much we would have considered that pretty much full employment.
Right, and I think that's still largely full employment based on kind of our current circumstances. So that's the fear, but that's what they're trying to balance is, the longer rates were what's now too high, the more things were going to break or more pain there was going to be. So they had to bring them down. They had to bring them down relatively soon by most people's estimation.
Well, and I agree with you, and they still have a long way to go. And if the dot plots on the statement yesterday are any indication of where this is all going, at least what the end game is, what the final result is, whatever you want to call it, probably 3.5%, maybe 3.25% on the overnight lending target from what I saw.
For next year?
Yeah, for next year. We're now at 5%. So that means that, hey, we still have another 150 basis points worth of cuts out there. And we shall see whether or not that's the magic bullet. But I do have to caution people who think that just because the Fed has cut the overnight lending target once, that doesn't necessarily mean that, hey, everything is going to start coming up roses. These things take a little while to work through the system.
Yeah, and some people talk about it, and the reality of it's maybe a little murkier, but this kind of J curve where things actually slow down a little bit.
J curve.
Or things, if you picture a capital J, slow down a little bit because of the expectation of rates to continue to go further down before people start really getting excited. So I'm not sure if that's the case in reality, but you're right. Either way,
they're not doing too much talk about the J curve in that meeting.
I don't think they are, but if I told you, you could get again, we're not talking mortgage rates, but you could get it at 6 right now, but you're going to be able to get it at 5 in a few months.
Hey, I'd hold off.
Probably hold off a little. So maybe there is some impact with the expectation that rates are going to continue to come down.
And I'm glad that you brought up mortgages because, for such a long period of time, people that are real estate brokers, agents, what have you, have been bemoaning the fact that existing home sales, even new home sales, have not been exactly where they would like for them to be. Real estate market isn't as hot for those people as they would like for it to be. People that sell furniture, people that do HVAC, all of it, just want to see a more vibrant residential real estate market. Do you think this 150 basis point cut is all of a sudden going to be that B12 shot in the arm or backside of the residential real estate industry?
I don't, but it's less about the cut itself and maybe this posture of further easing that I think could help it a little bit down the road. But when we talk about rates coming down, we're talking about basically the one rate that the Fed controls.
That's right.
And by association, short-term treasuries, but they don't control the mortgage market.
No,
they can help it.
Not directly.
I mean, but it's tied closer to the 10-year, which by and large is supply and demand and economic conditions. Right. So it's maybe they support economic conditions, but that should maybe bring rates higher. So I think that's a long-winded way of saying I don't think the 50-point cut is going to be this panacea for this slowdown in the housing market.
I think you're absolutely right on that. I think unless you want to take out some sort of floating rate mortgage, which I would recommend if you've got to do something like that right now, you take out a floating rate mortgage when interest rates are going down, right, Sam? You don't take them when they're going up.
If you have to take one out. If you
have to take one out.
If you don't, you should probably never take one out.
Yeah, Sam is not a fan of floating rate mortgages, doesn't sound like.
I'm not.
All right. But those people that have been maintaining a debt, some sort of balance on their revolving debt, their credit card, their home equity line of credit, or what have you, anything that floats against a benchmark, be it prime or SOFR, the old LIBOR, or whatever it is, 3-month T-bills, whatever it is, anything like that is all of a sudden you're going to get a little bit of a break. It's not going to be a massive break. I mean, 50 basis points on 10,000 or something like that. I mean, it's not going to necessarily change your lifestyle. Is that $500 a year?
Yeah, so
it's $40 a month. That's certainly going to help. But it's all of a sudden when we start looking at, hey, going down to 3.5 on the overnight lending target, that takes prime down to 6.5, which all of a sudden is 2 percentage points lower than where it has been. That's when all of a sudden those people that have built up a balance on their revolving debt start to feel a little bit of relief, I guess you should say.
Except those credit cards going from 24% to 22% over time. Making progress.
Yeah, every little bit helps.
I mean, yes, it does start to alleviate some pain in borrowers, but then there's this flip side where it's been very stimulative to have this much income coming in for so many people taking zero risk. And so that's the other side of it. I mean, the risk-free rate's been over 5%. Yeah. You have $1 million, which again is not the normal person, but $1 million just sitting in a savings account, that's $50,000 a year for doing zero.
So that brings up a very valid question. Now, while the Fed only really controls the overnight rate and the discount rate and a few other rates, but seriously, the overnight rate is the one that everyone pays the most attention to. And indirectly, the bill market generally tends to follow suit. I mean, it's just got the overnight rate, and short-term or money market rates are generally set off the overnight rate. Pretty strong positive correlation there. What does this mean? As you mentioned, the person with $1 million in their savings or money market account earning 5%, moving forward, they're making 4.5%, they're making 4%, they're making 3.5%. Wherever the Fed takes us on this, all of a sudden they start going, okay, well, the 5% or 5.35 or whatever it was felt pretty good. I'm not crazy about 3.5%. Does that money go back into the markets?
I'm sure a little does, but the question, and I don't have the great answer to it.
You can look in the crystal ball. That's like
I'm looking in it
2 feet away.
And I do not see the answer to my question.
There you go. All right. You sure?
But if someone decides that, hey, this cash on the sidelines, I'm going to go buy some stocks with it, that means someone else is selling stocks.
Yeah.
So yes, I think there's probably some incremental demand, but I think a lot of this money that we've seen, people are quoting how much cash is on the sideline, how much cash is in money markets. I think a lot of that is excess bank reserves that is then going to funnel back into the banking system.
Well, and that brings up a very interesting point, because right now, if you were to take a look at deposits across the entire banking system, what you would find is the larger banks, the money center banks, and a lot of the brokerage firms are sitting on mounds of deposits. Mm-hmm. I mean, their loan to deposit ratio is 60. I mean, they're just sitting on a ton of them. However, when you get down a little bit, sort of your regional banks, what have you, you're starting to look at some loan to deposit ratios north of 85-90%, meaning that, hey, they're pretty full up on loans. There's not a lot of there's not a lot of leeway there. There's not a lot of give. So what will happen if all of a sudden, hey, that person with $1 million in the money market account, or 250 or whatever it is, goes, I'm not making that 5% anymore. I'm making 3.5%, or I'm making 4%. I'm going to take even half of that and go buy an S&P 500 index fund or something like that. What do you think that could mean for the banking industry, as banks all of a sudden are really fighting it out, trying to maintain those deposits so they continue to make loans?
Yeah, and I it's a great point, and I think you have to differentiate, and you really, we're gearing it up for this, but the difference between those money center banks and the regional / community banks, because the money center banks, their average cost of deposits by and large is still less than 0.5%.
Yeah.
I mean, their quote unquote yield curve, what they were borrowing versus what they're lending at, that's been pretty steep this whole time.
Yeah.
This has been fantastic, this higher rate environment. The non-money center banks are where they've really had to fight more for deposits.
Yes.
And obviously the cost of borrowing for the banks to the deposits is much closer to the risk-free rate than for those money center banks. So that's where a lot of that competition is going to be, is in those regional / community banks, because those large banks, people aren't just going to JP Morgan for the highest rate.
No.
There's other reasons that
There's other reasons, knowing that, hey,
too big to fail.
Too big to fail. And if I've got, let's say, I'm Warbucks or whatnot, and I've got $1 million that I want to keep in deposit, again, that person with $1 million in the money market account, 250 is insured by the federal government. Mm-hmm. Whether or not the federal government actually has the money to insure it, that's beside the point. But 250 is insured by the FDIC, right? Mm-hmm. The remaining 750 is not, at least if they don't if they don't sort of stagger it and all that. There's ways to kind of layer that. Well, if that's the case, would you feel more comfortable at Joe Blow Bank or JP Morgan Bank? Understand that the Treasury or Washington literally cannot let JP Morgan fail.
Well, if my job,
the answer is obvious.
Yeah, if my job's on the line, if my job is to protect my company's deposits, that is a huge weighting towards where we decide to bank with.
Yes.
It's not the only one. Maybe if someone's paying 5% and the money center's paying you 0%, okay, maybe there's a tipping point to that. But that's inarguably the most important thing, is to first not lose your money.
Yeah.
So, I mean, that it's hard to overemphasize the importance of that. And that's why that, plus the massive retail deposit base for most of these banks. I mean, billions and billions sitting at 0% interest in checking accounts, because they have tens of millions of accounts.
Yeah.
So those money center banks are fine in terms of the cost of deposits. They're frankly their margins are probably going to get squeezed a little bit more, maybe.
Yeah.
So we'll see what happens with the regionals and the community banks that have had to fight it out a little bit more.
And I think we or they or whomever, however you want to phrase it, they'll have to fight it. They will have to continue to fight it out and pay attention what their competition's doing in terms of deposit rates and what have you. But a couple of weeks ago, I wrote in Common Sense about how it's going to be the first firm that cuts their deposit rates, and everyone else is going to make a mad sprint to the door. And I do think that's going to happen, particularly now that they cut it 50. Had it been 25,
maybe hold out.
I mean, people might have, okay, let's hold on and we'll get it the next one. It's only 6 weeks. Now that it's 50, I think it's a little bit different story on that. So I imagine that you'll start to see banks that are paying up for the deposits will start cutting them relatively short.
Yeah. And the other big thing I've heard since cutting rates, or really even before, is that cutting is not good for the market. Is I hear that all the time. And there's cases where that's the truth, but there's also cases where that's not the case, where the market does like easing. And it's really down to one big question. Are we easing because the economy's significantly slowing, or are we doing this as a tinkering of policy, a kind of renormalization of policy?
And that's a great question. If you're of a certain age, you might remember the expression, that's the $64,000 question. I'm not even old enough to remember that, but somehow I do.
I know the saying.
Yeah, I know the saying. You're right, because if you're cutting because you're too late to the game and you do a panic cut,
it's 2008.
It's too late. It's too late. This right now, at least according to the official data, suggests that they aren't too late. They might be preemptive. You have to remember the second quarter GDP report is what, 3%. We're still looking at unemployment at 4.2% officially.
3% for this next quarter estimates.
And so we're taking a look at things going, no, they're not. I don't think they're being reactionary. I think they're taking a look at data as it comes in. We're seeing the last CPI report was probably the best CPI report I've seen in a while, although the numbers weren't shocking. 2% for the overall, and well, not 2%, 0.2 of 1 percentage point, and then 0.3 of 1 percentage point for the core. But there were a lot of negative signs in the report. So I mean, I think the data is sufficiently weak enough that the Fed can get away with a 50 basis point cut, and just say, hey, we're just trying to get up the curve here. We're just that's
we're
all
jump starting it, and
we're trying to do. I could have even argued 100. However, that 100 basis point cut would have probably triggered all kinds of alarms and freak out bells and all that stuff. So 50 is the right call.
Yeah, if you could, mute all these other variables about the implied fear you're by doing 100, if you could just get it back to where we think kind of a more normalized, that R square or R star they talk about, 100 basis points, get it down to 4.5. See where things are.
Yeah, I mean, get it down to 4%, completely flatten the yield curve, and let's take it from there. So, here we have it, finally, September 18th, 2024, after talking about a Fed rate cut for going on 2 years, but really, I mean, probably about 18, 19 months, really seriously. The Fed finally delivers on one. I'm not sure the markets really completely understand what it means, in terms of overall economic activity. Yesterday, the stock market loved it at first, but largely closed the day kind of roughly flat.
Yeah.
And here today on the 19th of September, the stock market loves it again. The bond market hadn't really loved it, and I think for good reasons. When you make money cheaper, inflation expectations creep up, and that's historically the way it's been. However, I think the magnitude of today's rally will probably dissipate over time as people realize, hey, this stuff isn't going to show up immediately in the data. It's going to take a minimum of a couple quarters to have any sort of real, true impact. And the economy might continue to soften over the next couple of quarters, despite the fact that we've already had this one rate cut.
Yeah, the big change from yesterday to today for me is that we can now fully, it seems like, celebrate good economic data. For a large part of the last 2+ years, I mean, we've gotten so backwards that we're
keeping the Fed on the sidelines.
Good data was the market would sell off on good data and rally on bad data because that meant we were closer to, we just needed another rate cut injected in our veins. But the Fed has clearly made it apparent that they have started the cutting cycle. This was not a one-time 50.
Jay Powell said as much.
He said they have started the cutting cycle.
They showed the dot plots, showed target appears to be 3.5.
That creates this nirvana for markets if you are in a cutting environment where the economy and the individual companies are still chugging along. So we can now fully celebrate. Good economic data doesn't mean we're not getting rate cuts anymore. The only thing is if we got some horrible inflation data, which I don't see in the next few prints at least.
I don't see that happening either. Actually, I don't see that happening at all. Not at least not for the foreseeable future, unless all of a sudden we decide to print an additional $5 trillion worth of cash, which we did in 2020, which you never know. We might be willing to do that in 2025. Well, actually, Sam, I think if nothing else, it was fun to talk about something else besides the election and conversation here over the last couple of days. Everyone wanted to know just exactly what our thoughts were on the not only the rate cut, but then also what Jay Powell had to say about it. And just I think really my general thought process is, again, just kind of sum up really my take on it is, they did what they had to do. They were a little bit more aggressive than I thought they'd be, but I would have done 50 basis points as well. And I thought the academics and bureaucrats in them were going to be more gradual than the 50 basis point rate cut. I applaud it. I think it's fantastic. I want some more of it. I don't think it's necessarily this massive rocket for the economy or anything like that. It'll take a couple of quarters for it to fully start to have some impact. But the yield curve has been inverted for too long. Some sectors of the economy have hurt more than others, and it appears as though things have kind of stabilized. There's no reason to keep the yield curve as inverted as it has been. No reason to keep that overnight rate as high as it has been when longer term rates are significantly lower. So let's go ahead and let's try to normalize the cost of money in the U.S. economy, and hopefully things can get back to normal.
Sounds like a soft landing.
It sounds like a soft landing, which, by the way, I had a very soft landing this morning coming in from Baltimore on Southwest, 737. I was happy we made it.
Love it.
All right, guys, thank you all so much for listening. We always love to hear from you all. So if you have any comments or questions, please, by all means, let us know. You can always drop us a line at tradingperspectives@oakworth.com, or you can leave us a review on the podcast outlet of your choice. If you're interested in reading more or hearing more of what we got to say or how we think, please, by all means, go to oakworth.com, oakworth.com. Take a look underneath the Thought Leadership tab and find links to all kinds of exciting information, including previous podcasts of Trading Perspectives, links to our newsletter/blog, Common Sense, as well as links to our quarterly economic analysis and breakdown, all that good stuff called Macro Market and all its independent pieces, as well as other thought leadership pieces by our client advisors and Mac Frazier and his staff over on the advisory services team. So with that, Sam, going to give you a last chance to say something really awesome on this topic.
That's all I've got.
That's all I've got today, too. Y'all take care.